What if I told you there's a financial strategy quietly used by the top 1% of wealthy families? It's not gambling in the stock market or relying on pensions or Social Security, but a strategy to build protected, tax-advantaged wealth with stability and control. And what if I told you that this strategy is now available to the other 99%? Today, I want to introduce you to a solution that combines growth, protection, and flexibility in a way very few financial tools can. It's a private banking tool based on the Transamerica Financial Foundation Indexed Universal Life Policy, also known as the FFIUL2. Let's start first by clearing up a couple of things. This isn't about chasing returns. It's not about risking your hard-earned money. And it's definitely not traditional life insurance as most people understand it. This strategy is about redirecting a portion of your income, money you're already saving, into a financial asset account designed to provide long-term growth, market stability, downside protection, and tax-advantaged access. Think of it as a next-generation savings vehicle, engineered for people who want to grow wealth without exposing themselves to market losses. You may not be old enough to remember the slogan, "When E.F. Hutton talks, people listen." But when I was a kid, I wondered why anyone cared about what this guy had to say. I remember picturing a funny little man who looked like Elmer Fudd. Turns out he was no cartoon character. In fact, he was a self-made multimillionaire, one of the most prominent American financiers in history, who married Marjorie Merriweather Post, the heiress of the Post cereal empire. Together, they built the Mar-a-Lago Resort in Palm Beach, Florida. His namesake firm was one of the top wealth advisories in the world. Even though he passed away in 1962, his firm thrived well into the 80s. In 1977, one of his firm's genius actuaries, Harold Leff, created arguably one of the most revolutionary financial products in modern history. It's called the Indexed Universal Life Policy, what many refer to as the foundation of private banking. It was created as an answer to the needs of the firm's super wealthy clients and friends. They didn't trust banks and didn't want to park their assets in life insurance at the risk of missing gains in the booming financial markets. The E.F. Hutton strategy depended on investing client money into the bond market, using the bond yields to purchase options on the anticipated performance of the markets, then trading those options to earn healthy returns regardless of whether the market was up or down. This eliminated the risk of downside exposure and gave a realistic opportunity to beat the market's upside. But there were three really big problems with the strategy. Options could be purchased and traded on only 16 stocks, and those options only included the right to purchase low when the market was anticipated to go high. And even though the options exchange added automated price reporting, it was still difficult to manage this complicated vehicle for more than a handful of clients. But a few key things began to happen that allowed this concept to find its legs. In 1977, the Chicago Board of Options Exchange added a new type of option called a put. It was a trading contract that allowed the holder of the option to sell at a higher price than what the market was currently at. Then the big event. In 1983, the exchange added option contracts on indexes like the S&P 500, CBOE 100, and the Gold and Silver Index. This completely changed the game. There was now just one component missing. By 1992, computers had taken over the world. This was just what the doctor ordered. And within 5 years, in 1997, Transamerica took advantage of this by bringing this amazing financial tool to the masses. They were the first and are currently still the best IUL or private banking carrier in the world. Here's how it works. You contribute a percentage of your income into your policy, basically depositing money into your own private bank. Those funds go into an asset account, not the stock market. Your money is linked to a market index, such as the S&P 500 and various others, but it's not invested directly in the market. That distinction matters. And here's why. When the market goes up, your account earns interest. With the IUL as the foundational component of a private banking contract, you benefit from 113% participation, meaning you earn 13% more than the index itself, and it's uncapped. But main reason this contract is so amazing is that it guarantees no loss. That's correct. When the market goes down, your account doesn't lose value. It's guaranteed to grow at a minimum rate of 0.75% when the indices are down. Even if they're down double digits, your account still grows. That's why, over the last 20 years, while direct investment in a hybridized blend of the S&P 500, Nikkei, and Fidelity index funds averaged 6.5% due to multiple years with loss, the Transamerica FFIUL2 averaged 10.8%. Remember, your hard-earned income is protected. It's invested in bonds, and the bond yields are used to purchase and exercise options on these market indices. The most an option can lose is the price that was paid for the option if it expires before being executed. So there's no exponential downside. That's why you still earn interest, even if the market drops 15% or more in a year. And that, my friend, is both rule number 1 and rule number 2 of investing. Don't lose money. This creates a rare combination of growth, stability, and protection, something traditional investments simply can't offer. The traditional savings account offers safety, but almost no growth. The stock market offers growth, but no guarantees or protection. IUL policies structured properly, as private banking contracts, bridge that gap. They offer growth potential tied to market performance, protection from market downturns, tax-free accumulation, tax-free access to your money through policy loans, no required age to start using it, and no contribution limits like a 401k or an IRA. This is why the wealthiest families and corporations use this strategy, to store money efficiently and safely while letting it grow. Yes, major corporations, including Fortune 500 companies, use permanent life insurance, including index products, to fund executive benefits, key person protection, and deferred compensation plans. Banks hold over $200 billion in bank-owned life insurance to fund employee benefit obligations. The same strategies used by publicly traded companies can be implemented in your personal finances and your business for everything from executive retention to tax-advantaged benefit funding. This is a tool that the wealthy use, and now you have access to it. Here's where things get exciting. The real power of this policy comes from max funding. Max funding means putting in as much premium as legally allowed, minimizing insurance costs, and maximizing cash value growth. When structured properly, this transforms the policy from life insurance into a high-performance financial asset with super living benefits. This is when the IUL becomes a private banking instrument. This is how the wealthy build supplemental retirement income, tax-free income streams, legacy wealth, and emergency liquidity. Did I mention that all of these benefits are tax-free? And the best part? Now you have access to it. The truth is simple. The top 1% don't rely solely on Wall Street. They use private financial instruments designed to protect and grow capital. For decades, these tools were hidden behind private banks, corporate balance sheets, and exclusive advisors like E.F. Hutton. Today, you have access to the same strategy. The difference isn't income, it's education. This strategy is ideal for people who want growth without market risk, are tired of volatility and uncertainty, want tax-free access to their money, believe in building wealth intentionally, want to protect their family and legacy, or all of the above. Whether you're a professional, a business owner, an entrepreneur that has been searching for a system to protect themselves from the uncertainties of providing their own income, or someone simply ready to be smarter with money, this strategy was designed with you in mind. This tool isn't just for protecting numbers on a page, it's for protecting your life, your time, and the choices you'll want to have later. The truth is, the next 20 years will seem to move faster than the last 10 ever did, not because life speeds up, but because responsibility, opportunity, and consequence do. This isn't the season to keep thinking about a plan. It's the season to live inside one, because if nothing changes, if you keep doing what you've always done, time has a quiet way of slipping by. And one day, the desire to wait and see will feel safer than starting, even when you know deep down that waiting is what cost you the most. This is about giving your future self options, peace, security, and the freedom to choose, not settle. The best time to put this in motion isn't someday, it's now, while time is still on your side. The question isn't if this strategy works. The question is whether it fits your goals, your income, and your future vision. The next step is simple. Schedule a short, no-pressure strategy conversation to see how much of your monthly income you could contribute, if perhaps max funding could work for you, and how this tool could change your financial trajectory. The strategy of the 1% is no longer a secret. Treat your money better and it'll treat you better. It's simply a decision. Scan the QR code to book a time to get a free consultation, or email the words, "Send me a proposal," to the email address on the screen.